So after all that speculation, has the new budget that was just delivered to the House of Commons come out worse than expected? I watched it all live this afternoon alongside my community. Here's everything you need to know and my initial thoughts. Now, I am planning on doing a deeper dive over the next couple of days, as I think there's a lot to unpack here, so do make sure you're subscribed to the channel if you're not already. Anyway, let's talk money. Okay, so quick background to this budget. As you'll know, this is the first budget of the new Labour government, and there was a huge amount of speculation surrounding it. Keir Starmer and Rachel Reeves have been telling us all just how bad the public finances are, and there is a £22 billion black hole that needs to be covered up by putting taxes up. Now, there's been an ungodly amount of speculation about which taxes are going to be put up, as the Labour government have made it clear they were not going to change income tax, VAT or national insurance, which for reference are the largest three sources of income for taxation. This only left all of the much smaller slices, which include things like corporation tax, inheritance tax, capital gains taxes, and so on. There was also so much speculation around things like pensions, ISA limits, and all of the rest. And we can now finally say what's been changed and what isn't. Generally speaking, though, I will say that this has not been as bad as what was forecast and expected. If you disagree with that, though, I'd love to hear from you in the comment section explaining why. Right, starting from the big changes, let's work through them all one by one. The national minimum wage will rise in the UK from the next financial year, so that's April 2025, remember. The figures are going from £11.44 to £12.21 an hour for anyone over the age of 21, and the other figures on screen now will apply if you're under that age. As a quick calculation, I make that a 6.7% uplift if you're over the age of 21, and for 18, 19 and 20-year-olds, you're getting quite a bumper lift. That's a 16% pay rise if you're in that age range, which will be welcomed by a lot of people if my maths is correct. However, the key thing to say here is that this is ultimately paid by the employers, and if the employers have higher costs, the big question will now be how much of this gets passed on to consumers and the rest of us. If prices also rise by the same amount, then the pay rise won't be as effective. At the moment, inflation is under 2%, so those pay rises look good in real terms, but we'll need to keep an eye on this thing over the long term to see what the effects will actually be. I'd love to get your opinion on this change if you're a small business owner, but please do let me know in the comment section. Next one, now we're getting into the real meat of the budget with major changes to the tax system. First up, let's talk capital gains taxes. These are paid by individuals who make a profit when they sell something, which could include things like second homes, stocks and shares, or even cryptocurrencies like Bitcoin. At the moment, the rates vary depending on two factors, and those are what you're selling and whether you're a basic rate taxpayer or a higher rate one. Now, I'll pop on screen now the current rules and use this as a guide to show you the changes that are being made. At the moment, the rates are anything between 10% and 24%, with the highest rate being for higher rate taxpayers selling residential property. Please remember that you do not pay capital gains taxes on your primary residence. Remember, this is only for people who might be owning second homes and renting them out, for example. The changes made here are the following. The lower rate of 10% is being moved up to 18%, and then the higher rates at 20% are being moved to 24%. So what this means is that everything is being moved to that row here effectively, so it's all the same. So no matter what you sell, the capital gains tax will be 18% for a basic rate taxpayer and 24% to a higher rate one. It's worth a reminder that everyone in the UK is given a capital gains tax-free allowance, so this tax only applies if you sell something and make a profit of more than £3,000. This allowance is staying the same and was put in place by the last government where, yes, it did used to be much higher, but that's where we are now. I should add here that this change is coming immediately, so these new tax rates apply from today, unlike everything else which is taking place in the new financial year. And yes, there are a couple of caveats to that. Let me just quickly say that although these are some big changes, capital gains taxes are only paid by a very small number of people. So last tax year, only around 360,000 people paid any kind of capital gains tax, and most of it is paid by a very small number of people. The latest stats tell us that 41% of all capital gains taxes came from 1% of taxpayers who made gains of £5 million or more. Again, let me know if you think this is a big change or not and whether it will actually affect you. For those of you who are worried and started to panic sell your second homes, nothing has changed at all, as the rates that you were going to pay on residential property are now the rates for everything else. Finally, I should add that carried interest, something that affects a very small but wealthy number of investment managers, is being increased to 32% in April 2025. Now, this has been a way for money managers to pay themselves without using traditional income tax rates. Next up is inheritance tax. This is another one that is only paid by a very small number of people. In fact, it's about 1 in 20 estates in the UK, or 5% if you prefer percentages. There are a couple of changes being made here, but the biggest one is that pensions will start to be included in the estate from April 2027. At the moment, pensions are excluded and don't count in the estate. So that's a good couple of years away, and a heads up for all of the financial planners out there with their clients, no doubt will be having those discussions. Remember here that we're talking about private pensions, which are defined contribution ones, and we're not talking about obviously the state pension or defined benefit pensions. These have got their own rules. Also, a few tweaks are being made to what other assets have been exempt, like farmland and family businesses. These will now have some tax paid above amounts of more than £1 million. I should add that the inheritance tax thresholds are being frozen as well. So at the moment, everyone gets given a £325,000 nil rate where no tax is due. If you include property in this, you get a limit of £500,000 before anything needs to be paid. As a couple, this effectively doubles. If a spouse passes on all of their assets to them alone, you can get up to £1 million without paying anything with inheritance tax. Currently, this tax raises £7 billion of the total budget, which is around 7% of the total tax take for the country. Now, the next big one is national insurance. It's not something that you'll pay as an employee, but this will be something that has to be paid by businesses from their side. So from the next tax year in April 2025, the rate of national insurance is being increased by 1.2% from 13.8% to 15%. Alongside that, the threshold that employers start to pay national insurance will be reduced from £9,100 per year to £5,000 per year. This will mean that a lot of businesses will have a higher tax bill for national insurance. However, to protect smaller businesses, the government is increasing the employment allowance from £5,000 to £10,500 and removing the £100,000 threshold. I have to admit I'm less clued up on this point, so I'd have to run the numbers to see what a difference this will make to the average business. Now, I suspect it will hit the larger ones a lot more, obviously, as it was intended to, but I'd love to get your view as a smaller business owner in the comments below. I presume this means that small business owners won't get affected. That's something I'll have to investigate later, but do let me know if this is a big hit for you. You could argue here that this is a broken promise, as Labour did say that it won't touch national insurance, but they will argue that they meant it will not affect your pay packet as an employee. However, if businesses hire less people as a result, then you could make the case that this does affect working people. Again, let me know your thoughts below on this one. Right, and then the final big one, before I cover the smaller ones, is that income tax rate thresholds will remain frozen until 2028, as they were going to under the last government. This means that technically we'll all be paying more income tax as we slowly get dragged into the tax bands more and more with higher wages. For example, quoting The Guardian here, they say, overall, the figures show that in 2024-2025, there are an estimated 29.5 million basic rate taxpayers, up 2.1 million since 2021-2022. The number of UK higher rate taxpayers has increased to 6.3 million people from just over 4.4 million over the same period. Now, after 2028, the government have said that they will look to increase the threshold with inflation, but until we get to that day, anything can happen. And I think that opens the door to just leaving those thresholds in place, effectively creating a stealth tax for everyone. I think this is probably going to end up being another one of the largest sources of income from the government, and any government for that matter, if they keep doing this. I think the reality is that most people don't understand taxes and taxation, so rather than try to educate people about it, they'll just keep doing things like this without being honest about how things work. Hopefully I can at least play my part to explain things, and I think this could be another video in my deeper dive in the next couple of videos, so do look out for that. Now, final things to note, but not everything that was in the budget, is stamp duty increasing for buying second homes, buy-to-lets, and anything purchased by companies in residential space. That's going from 3% to 5% immediately, so you don't have any space to wiggle there, I'm afraid. Landlords are certainly going to feel the squeeze here. I'd love to get some views again on this one below. Does this make property investing less exciting? If so, I have some videos about investing in the stock market that you might like, hint, hint. Now, secondly, you have the VAT on private schools confirmed, so no tax break for those people who can afford to send their kids privately. That market is private, so they can charge what they like, and costs have gone way up more than inflation recently anyway. Then you also have bus ticket prices going from a cap of £2 to £3 in 2025. My missus will not be pleased with that. And then good news is for motorists, fuel duty free stays in place, so nobody can claim the Labour government cost them more money at the pumps. Right, and I think that's about everything I wanted to cover. So here's my thoughts and conclusions briefly. I think it was not as bad as expected. The speculators made out this was going to be a massive pension and ISA raid. Shame on them for getting people all worried. I hope you rethink about who you listen to online after this. And I even did a video myself saying how I'm doing nothing before the date of the budget as speculation is dangerous. Anyway, other than that, I think it's fair and reasonable. The main changes in inheritance tax and capital gains taxes affect such a small number of people, and although it will be meaningful to them, those rates are very similar to other countries that we compare ourselves to. The UK is not a super high tax country like some other Nordic ones, and there are still a ton of tax breaks available to you if you know how to use them. The super rich are still going to be able to get around most of these anyway. In terms of income tax thresholds staying frozen, this is a shame, but it's an easy way out, and every government will probably continue to do this rather than put the percentage tax rates up. And finally, there is a lot about investment, which all sounds good, and I genuinely hope the public sector services get what they need, but it's more than just money that they need, so we need to start figuring out the difficult questions. I hope that we can grow and keep inflation under control as the OBR have predicted, otherwise we'll be back here to the drawing board again. Anyway, thanks for watching, and I'll see you in the next video. Happy investing.